So today we're looking at an analysis of Yuja Digital's, or YDKG's, huge 26% surge on December 1st.
Right.
The report attributes this pop to low float dynamics after a reverse split, especially since the rest of the crypto market was tanking. So let's jump right in.
Yeah, let's do it. And I'll say right off the bat, the premise is strong. Recognizing that this thing flew while its peers were crashing, that's the whole story right there. It correctly steers you away from fundamentals.
Absolutely. But, and this is our first point, the structure needs to fully commit to that from the very beginning.
Exactly.
So our first area to focus on is sharpening that trade, not investment thesis. The analysis gets there. It correctly identifies this as a momentum play. But the report would just hit so much harder if that high-risk framing was, right up front.
Yes. The weakness here, really, is at the most critical verdict, that YDKG is strictly a trade. It doesn't appear until the final actionable conclusion.
It buries the lead.
It completely buries the lead. So you have Section 3, the financial reality check, and Section 4, the forecast, and they lay out all these fundamental weaknesses.
Negligible revenue, burning cash, another capital raise.
Right, all presented as standalone facts.
When really, they're the proof. The report makes this ironclad case for why the stock is fundamentally a disaster, but it presents the evidence almost offensively.
It does. If the fundamentals are that bad, the structure should be screaming that the price action has to be purely mechanical. There's no other explanation.
Precisely. So the suggestion is to explicitly use those fundamental weaknesses to validate the mechanical thesis from the start. Frame that whole financial section not just as a reality check, but as the absolute reason why you cannot hold this thing long term.
It preempts any questions and justifies the entire high-risk angle of the piece.
Okay, so let's give some concrete examples. What are some actionable steps here?
Well, first, that section header. Financial reality check is too soft. It's too gentle.
Yeah.
It needs to be direct. Something like financial constraints, why investment is prohibited.
Ooh, prohibited. That's strong.
It is. But it immediately changes the psychological tone, right? It's a final judgment, not just an FYI.
That's a fair point. You could argue prohibited might feel a little aggressive, but I think you're right.
Well, given the context.
A 26% surge on a stock like this?
Exactly. The report is titled something like, YDKG explodes. Is this the start of a massive run? You have to communicate the risk immediately. It's about credibility.
I'm with you. Clear risk communication is everything in these low-float situations.
Okay, then you get into the data points. The report mentions that $28 million offering from October. That's a huge dilution risk.
But it's kind of buried.
It is. So you need to link it directly to the thesis. State it plainly. Something like, this reliance on capital raises is the primary driver for our trade not investment verdict, as future dilution is the highest probability risk.
So you're establishing the risk profile as the foundation for the entire analysis.
You have to. And then that framing flows right into the forecast. You make it explicit that any price scenarios you're outlining are purely momentum driven.
And totally decoupled from any kind of real intrinsic value.
Exactly. It reinforces the whole high-risk premise from top to bottom.
Okay, that makes perfect sense. So, moving on from the fundamentals, let's talk about the mechanical trigger itself.
Yeah, the fun part.
The fun part. So this brings us to our second point. We need to bolster the causal link between the reverse split and the timing of the squeeze. I mean, identifying the 1-for-100 split on November 14th as the catalyst is insightful. That's the right call. But the report needs to connect the dots more robustly to the December 1st price explosion.
Right. This is where we have to go from simple correlation to demonstrated causation.
Talk about that.
Well, the analysis correctly says the low float, around 5.5 million shares, is because of the reverse split. Great. But there's that 2-week lag, November 14th to December 1st.
And any sophisticated reader is going to ask,
why December 1st?
Why not November 15th?
Exactly. The report just assumes the split caused the squeeze, which it likely did, but it doesn't address that gap in time.
Right. So why did it pop specifically when volume hit 1.4 million shares on that one day? That's the missing piece.
So the suggestion is to add that missing analytical step. You have to explain what happens mechanically during those 2 weeks.
Float compression isn't instant.
It's a process. You have to confirm that the full effect of that compression was only really felt by December 1st, or you need to specifically call out that volume spike as the final necessary ingredient, the ignition.
That is such a subtle but crucial refinement. It adds real analytical depth because you're explaining the process of how a supply shock actually stabilizes.
Without it, you're just leaving the reader to connect two events that happened 2 weeks apart. You haven't shown them the wire that connects them.
So how do we make that tangible for the reader?
A simple transitional sentence would do it. In that section on the real catalyst, you could just add something clarifying the delay.
Like what?
Something like, float compression takes time to fully translate into a supply shock as institutional positions stabilized post-split,
Okay.
creating the necessary vacuum that was finally tested on December 1st.
I like that phrase, the necessary vacuum, that closes the loop. It solved the time gap problem.
It turns it from just correlation into a clear causal chain of events.
Yeah.
And then, to go one step further, you have to treat that 1.4 million share volume spike not just as a result of the squeeze,
But as the trigger.
the required trigger. Yeah. Momentum traders live for that kind of volume signature. You have to state that explicitly.
Give me an example.
You could say, the spike in volume to 3 times the average, particularly during the power hour, acted as the critical igniter that finally tested the newly tightened float.
And by specifying power hour and 3x average volume, you're grounding it in real observable trader behavior.
It shows you know what you're looking at. It proves this was the moment the spring, finally uncoiled.
That's super actionable. I love it. Okay, so let's turn to an issue of, let's call it, analytical purity. It's about how the report mixes its facts.
Ah, yes. The valuation metric.
Exactly. The report introduces this confusing and honestly distracting detail about YDKG's valuation. It either needs to be fully baked into the low float thesis or just cut for clarity.
Yeah, this one jumped out at me. So, in Section 3, it mentions the stock trades at a tiny fraction of its book value.
Like 0.03x or something.
Right. And it says this might attract, deep value algo bots. But then in the very next breath, the report says the metric is distorted by the reverse split and basically meaningless.
Which creates this narrative stumble. You're including a metric just to immediately dismiss it.
It's analytical dissonance. It just weakens the focus, which should be laser sharp on the supply and demand mechanics.
Right. If the whole point is that this move is purely mechanical, not fundamental, then this financial detail needs to be streamlined.
So we have to decide, is that 0.03x number useful as a mechanical trigger, or should it just be removed entirely to keep the focus on the real risks, the cash burn and dilution we talked about?
Okay, let's play out that first option. Say we keep it. How do you integrate it without confusing people?
You have to completely reframe its purpose. It's not a valuation metric anymore. It's a signal.
A trigger.
An algorithmic trigger. So you could rewrite it to say something like, while the 0.03x book value is mathematically distorted post-split, this extremely low number acts as an initial signal,
Okay.
attracting quantitative deep value algos that provide the necessary starting liquidity for the subsequent low float squeeze.
Now that's a sophisticated fix. You're putting the metric squarely in the camp of market mechanics. The number itself doesn't mean value. It's just an input for a machine that starts the buying.
Exactly. It serves the core thesis.
But what's the other option? The cleaner one.
The cleaner option, and maybe the better one, is just to cut it. Remove the reference to book value entirely.
And what does that do for the section?
It makes Section 3 purely about risk. Its only job is to prohibit an investment thesis. So the focus is exclusively on the tangible risks. Negligible revenue, net loss, and dilution risk remain the critical, non-negotiable fundamental facts.
That definitely increases clarity. It reduces the cognitive load on the reader. The goal is maximum impact, right? And less ambiguity in the mechanical thesis is always better.
For sure. Look, the expertise in low float dynamics is the biggest strength of this whole analysis. These are just adjustments to make sure the delivery, the structure and flow is as sharp as the core insight itself.
I agree. This analysis report is already 90% of the way there. It immediately sees the divergence from Bitcoin's price, which is the key. It confirms this is a supply-driven story.
It nails the key ingredients. The low float, the high volume, that classic power hour signature of the day traders. It's all there.
Okay, so to summarize the main points for the listener. First, integrate that trade, not investment verdict, into the very fabric of the report. Use the fundamental weaknesses, the cash burn, the dilution, as proof points for why this is only a momentum trade. And maybe use a stronger header, like your why investment is prohibited.
Right. Second, you have to strengthen that causal link. Bridge the 2-week gap between the split and the squeeze.
Explain why that volume spike on December 1st was the specific igniter for a situation that had been building for weeks. Resolve that timing question.
And finally, streamline the use of that book value metric. Either repurpose it as a mechanical trigger for algos. Suggestions are going to really elevate the report's authority. The reader will grasp the risk and the mechanics in